Hello everyone, and thanks for watching Edupedia World Videos. This is the second session for basic terms of accounting, and we'll start with assets. What we mean by assets is economic resources of an enterprise. And these economic resources can be usefully expressed in monetary terms. Now the assets are items of value used by business in its operations. For example, if a super bazaar owns a fleet of trucks which provide economic benefit to the enterprise by delivering foodstuffs, it is called an asset. And this item will be shown on the asset side of the balance sheet of super bazaar. Now, the assets are broadly classified into two types. Namely, fixed assets and current assets. Fixed assets are assets held on a long-term basis. These assets are used for normal operation of business, while the current assets are held by the firm on a short-term basis, such as debtors, bills receivables, marketable securities, cash in bank. Stocks are considered to be a part of current asset. But before we classify fixed asset and current asset, we need to understand that something in which the firm is dealing, that particular thing is considered to be a current asset even if it looks to be a fixed asset. Now suppose if a firm is manufacturing tables and chairs, it doesn't mean that it would be accounted as a fixed asset, although these are furniture and fixtures which needs to be in as fixed assets, but as the company is operating in it, it would be considered as stock. Similarly, if a company is operating in real estate, the flats that it prepares to sell out to the customers would be considered as current asset, not as fixed assets. Now we will understand about liabilities. Liabilities are obligations or debts that an enterprise has to pay at some time in the future. They represent creditors' claims on the firm's assets. Now, few of the time we have this doubt, like a debt is said to be a liability. That depends upon the operation of the business. If a bank shows debt in its balance sheet, this is an asset for the bank, while if it is shown on some other firm's balance sheet, then it would be on the liability side. As a bank earns because of debt, so it acts like a economic resource and is expressed in monetary terms, so we can call it an asset, while the other firm has to pay it back to the creditor or maybe long-term creditor, so it is called liability for that particular firm. Now, liabilities are classified into two types again. Long-term liability and short-term liability. Long-term liabilities are those that are usually payable after a period of 1 year, while the short-term liabilities are obligations that are payable within a period of 1 year. Now let us understand what do you mean by capital. Capital is the amount invested by the owner in a firm. It may be brought in the form of cash or assets by the owner for the business entity. It is an obligation and a claim on the assets of the business, and it is therefore shown as the capital on the liability side of the balance sheet. Now the next topic is sales. Sales are total revenue from the goods or services sold or provided to the customers. Sales may be in the form of cash or credit. Now we will understand about revenue. These are the amounts of the business earned by selling its product or providing services to the customer, called sales revenue. Other items of revenue common to many businesses are commissions, interest, dividends, royalties, rent received, and so on. Revenue is also called income sometimes. Now we'll understand about expenses. Expenses are the costs incurred by a business in the process of earning revenue. That means if a firm is establishing a plant, the rent paid, the depreciation, the wages, the salary, the interest, and Various other costs like light and water, telephone, etc. are the expenses for that particular business. Generally, expenses are measured by the cost of assets consumed or services used during an accounting period. Now, what do we mean by expenditure? Spending money or incurring a liability for some benefit, service, or property received is called expenditure. Payment of rent, salary, purchase of goods, purchase of machinery, purchase of furniture, etc. are examples of expenditure. If the benefit of expenditure is exhausted within 1 year, it is treated as an expense, or it can be called as revenue expenditure. On the other hand, the benefit of an expenditure lasts for more than 1 year is called as a capital expenditure and treated to be as an asset. Now we will understand about profit. The excess of revenues of a period over its related expenses during an accounting year is profit. Profit increases the investment of the owners. The next one is gain. A profit that arises from event or transaction which are incidental to business, such as sales of fixed assets, winning a court case, appreciation in the value of an asset, is called as gain. Losses. The excess of expense in a period over its related revenues is termed as loss. It decreases in owner's liability. It also refers to money or money worth lost without receiving any benefit in return. Now we will understand about discount. Discount is the deduction in the price of goods sold. It is offered in two ways: offering deduction of agreed percentage of list price at the time selling of goods is one way of giving discount, and such discount is called trade discount. It is generally offered by manufacturers to wholesalers and by wholesalers to retailers. After selling the goods on credit basis, the debtors may be given certain deduction in amount due in the case if they pay amount within the stipulated time period, or maybe earlier. This deduction is given at the time of the payment on the amounts payable. Hence, it is called cash discount. Cash discount acts as an incentive that encourages prompt payment by the debtors. Now we will understand about drawings. Withdrawal of money or goods by the owner from the business of personal use is known as drawings. Drawings reduces the investment of the owner. We will end this session here and we'll continue with this topic in the next session also. Thank you for watching this video.